Let's bring in Bill Lee. He's Milken Institute's chief economist. Bill, welcome. What do you think and predict they will do?
Well, Kelly, you asked me 3 months ago in March, what's wrong with raising rates by 100 basis points? And I said, the markets aren't ready for it. Well, right now, you're seeing the markets are daring the Fed to raise by 100 basis points or at least 75. But unfortunately, Chair Powell is a consensus builder. He's not a Paul Volcker and a leader. So I don't expect he will take up the challenge that the markets have thrown down and say, OK, let's go 75 because the markets are anticipating it. We need it. And we'll restore our credibility. Instead, he's going to say, well, I promised you 50. I'm going to give you 50. But, watch out next time, because as the data get worse, we're going to do more. And that's about as far as he's going to go.
You phrased that interestingly, though, and I've heard from a number of traders who agree. They think that the market is actually saying to the Fed, go ahead and do something bigger here. That's not to say it's priced in fully, but there's an opening, isn't there?
Oh, absolutely. And the markets, I think, are in a mindset where they are absolutely convinced it takes a huge recession induced by high rates to knock this inflation out of the numbers. And unfortunately, markets are, and the Fed itself is underappreciating how important a balance sheet tool could be. The Fed could really tighten policies very nicely, raise long-term rates and not raise the short-term rates as much, which is where a lot of small business loans are, inventory loans, and that would really crush the economy. And they could really preserve the recovery by saying we're going to accelerate the balance sheet and raise 75 basis points.
Do you think they're being a little gun-shy on the pace of balance sheet tightening because of the repo crisis that happened the last time around in 2018 and 2019?
Absolutely. The great unknown for most economists at the Fed and for all of us in the financial markets is what impact will an accelerated price of QT have on the repo market and the plumbing of the financial system? Well, if whatever happens, right, the one thing that we know we can do is we can fix it. But the one thing we have to set out there is that the Fed is credible in being an inflation fighter. And the fact that it's tying its one hand behind its back and not using all its tools is, to me, absolutely shameful.
So we could say if you were on the FOMC this week, Bill, you would dissent in favor of a larger balance sheet reduction, maybe not so much on the rate side of things. But what should they do now to get ahead of a problem that you just heard Professor Demoterin articulating quite well, that they probably needed to have gotten ahead of a year ago?
A year ago is a year ago. What's gone is gone. Looking forward, the Fed has got to say, I'm going to take up the Volcker-Draghi challenge and say, I'm going to lead. And unfortunately, Chair Powell just doesn't have that kind of personality to say, let's do what it takes to get rid of the inflation expectations that are being built into the economy. Right now, the last thing the Fed ever wants to see is inflation expectations getting unanchored, and we're on our way to letting that happen.
What about those who say, you know what, this is just an energy market problem, and maybe Washington or the White House should be taking the lead instead?
That's what we said in the 1970s when we said, oh, we need some wage price controls because it's really this market, that market, it's the market for peanuts. I mean, you can always find some markets that are more excessively priced than others. But the general problem is we've got way too much demand for the amount of supply that's out there. Regardless of what's caused supply to shrink, the Fed's job is to equilibrate supply and demand. And the Fed has not done that.
All right, we'll leave it there. Bill, thank you very much. We'll hear from the Fed itself in about 48 hours' time. Bill Lee.